Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. We have just released our monthly India market outlook titled Can the Upturn Sustain? In today's podcast, we summarize our asset class views and address the key question, why do we expect equities to outperform other asset classes? Before we get started, a quick roundup of the past month. The rally in Indian assets has continued despite global headwinds, supported by a strong first quarter FY23 earnings, falling commodity prices, and a resumption of foreign investor inflows into equities. Over the past month, the Nifty index is up 1.7%, while the Nifty Midcap index is up 5.7%. The INR recovered from a new all-time low of 80.13 per dollar, but still depreciated 0.1% against the USD, while the benchmark 10-year Indian government bond yield fell by 14 bips to 7.17%. So given this backdrop, what is our outlook for asset classes going ahead? In the short term, the risk of a pullback remains high, given expensive valuations of Indian equities relative to its peers and stretched technical positioning post the recent rally. In our view, the case for Indian equities on a 12-month horizon remains strong given the following drivers. First driver is a still robust earnings growth outlook. High-frequency indicators such as PMI, industrial production, vehicle sales, power demand, etc. continue to signal above-trend domestic economic growth. We expect GDP growth to remain above 7% in fiscal year 2023, supported by greater public investments, resilient consumption, and nascent signs of a revival in private capex. The second driver is resilient corporate earnings cycle. Earnings delivery remains robust despite numerous headwinds. India's earnings expectations continue to be ahead of peers with a likely third consecutive year of double-digit EPS growth, with an estimated 17% for the benchmark Nifty index for the fiscal year ending March 2023. The third driver is repricing of higher interest rates. In our view, markets have priced in a significant part of likely central bank rate hikes, with the terminal repo rate likely to be lower than previous rate hiking cycles. Finally, the fourth driver is the resilience of domestic equity market flows. Stable domestic equity inflows and a structural shift in household savings towards financial assets continue to be key supports for the market. The recent resumption of foreign investor flows into Indian equities is an additional tailwind. Moving on to individual asset class views, Indian equities remain our most preferred asset class on a 12-month horizon. Within equities, we prefer large-cap equities over mid- and small-cap equities on relatively better macro fundamentals and greater margin of safety in terms of earnings and valuation. We expect the value outperformance to broaden further in 2022. Our key investment themes, India's investment revival and broadening value rotation, are likely to benefit in a mid-cycle environment. Bonds remain a core holding as average yield premiums are counterbalanced by weak fiscal dynamics and worsening government bond supply and demand balance. Rising interest rate is another headwind for bonds. Within bonds, we retain a preference for short maturity bonds given lower sensitivity to rising interest rates. Cash remains a core holding, and finally, gold also remains a core holding and a good portfolio hedge against inflation and equity market volatility. That's it in today's podcast. In the coming podcast, we will discuss the key question, how can investors navigate volatile markets? So do reach out to your relationship manager for a copy of our Indian Market Outlook. And thank you as always for listening. If you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.